We saw what primary adjustment is. Let us look at secondary adjustment. Okay, and for an example, I'm taking fee for technical services over here. Now, what is a secondary adjustment? Let's first look at an example, and that will give us more sense around this concept. So suppose there's a foreign company based out of US, which is 100% owner in an Indian company. The Indian company makes the payment for fee for technical services to the parent, right? The ICO, let's look at the fact side, paid an amount of rupees 110 to the foreign company, which under the TP methods was benchmarked to be rupees 100, right? The foreign company has been taxed on royalty income at rupees 100 by application of Article 12. Why? Because Article 12 specifically provides that if there is an excess payment made to a foreign company vis-a-vis the arm's length price, then what is taxable under Article 12 will be only the arm's length price. In line of that, the foreign company has been taxed on royalty income at rupees 100. The issue is, how would the tax be levied on the remaining 10 rupees? So one of the suggested way forward, and the way the secondary adjustment will work, is that if you just for a minute forget about the foreign company, right? If the Indian company, from an Indian perspective, were to pay this excess 10 rupees to the foreign company, if it was not FTS, then they would have paid this by way of dividend, right? The dividend paid would have been liable to dividend distribution tax in the hands of the Indian company here. And then the foreign company would have been exempt from tax on such income. In order to apply such secondary adjustment, the ICO may be considered as liable to pay DDT on the excess payment, right? And the foreign company would be exempt from such dividend in its own hands. This is what a secondary adjustment is, which effectively restores the taxation if originally what was paid was 100 rupees as royalty and rupees 10 as dividend insofar as the source state is concerned.